After we have all the financial statements prepared, you may think, okay, we're all set, right? No, we just finished the preparation of financial statement for the current accounting period. In this case, it is the financial statement for July 2024. Remember, there are still more business activities in the next month and in the future. So we should prepare for the next accounting period. And the next step, step 9, is to close all the temporary accounts. The purpose of the closing process is to close all the temporary accounts. Closing means we reduce the balance of these temporary accounts to zero. Temporary accounts include 3. All the revenues. If there's gains, they are also temporary accounts. Expenses, temporary accounts. If there are also losses, they are also temporary accounts. The last one is dividend, if there's any. So these are 3 temporary accounts we should close. We change their balance to 0. We know revenues, they have credit balance. We just debit these accounts for the same amount. Then its balance becomes 0. For expense, dividends both have debit balance. So we just credit these 2 accounts, their balance will be 0. When we close them, their balance becomes 0. Not means their balance disappear. Their balance actually are transferred to retained earnings through closing journal entries and posting procedures. Let's take a look at the procedures. During this month, July, the company recognized 2 revenue. The sum of 2 revenue was 38,750. And we can go back to the adjusted trial balance. That's the 2 revenue. Total credit 38,750. We just debit revenue accounts. In the T accounts, the sales revenue had $38,500 credit balance. After this journal entry, we debit its accounts. Its balance becomes 0, right? Because for this T accounts, debit equals to credit. Same for the rent revenue. Rent revenue was 250 credit. Now we debit 250. It becomes 0. So these 2 accounts are closed. Their balance total 38,750. Now move to retained earnings. Originally, both have credit balance. After you close them, their credit balance moved to another account, retained earnings. We do the similar process. For the expenses, they all have debit balance in the T accounts. Now we credit the same amount. Then their balance are close to 0. And the sum of them will move to retained earnings. Retained earnings, debit. Dividend had debit balance 1,000. Now we credit dividend. The dividend balance will be 0. And the debit balance of dividend now move to retained earnings. In summary, when we close these 3, we credit retained earnings, debit revenue to close revenue. We debit retained earnings while credit all the expenses to close expense accounts. We credit dividends, debit retained earnings to close dividend accounts. Finally, the retained earnings 1,917. It is just equals to the number we got from the statement of retained earnings. So these 3 journal entries, they are closing entries, but they are also journal entries. We will do the posting again in a general ledger. As what I described, these accounts, revenue, expenses, dividends, their balance will be 0. They will be removed from the trial balance and replaced by a new account, retained earnings. See, these accounts keep the same balance as the adjusted trial balance. Okay? Yeah, we don't close them. That's why we call them permanent accounts or real accounts. Their balance will not be closed. We will keep using for the next accounting periods. While all the revenue, expenses, dividend will be close to zero. They will start over for the next accounting periods. And because their balance are zero now, we remove them from the trial balance. Instead, we replaced them with retained earnings. 1,917. Now you will see this trial balance is a lot shorter, right? Because it only includes accounts of the balance sheet, no accounts for income statement and dividends. When we have this trial balance, this is the third trial balance, post-closing trial balance. All the balance of each account is the ending balance of July, but they will become the beginning balance of the next accounting periods, the beginning balance of August. Step 9 and 10 basically are prepared for the next accounting cycle or next month. That's pretty much about the chapter 2, the accounting cycle. How to start from transaction analysis to financial statements, and then we close all the temporary accounts and prepare for the next accounting cycle.